Good morning, traders and investors. Roger Scott here, senior strategist for the Trading Pub. It's Tuesday. It's November. It's Tuesday, December, not November, December 19th. And boy, oh boy, where has the year gone? It's about 7:45 in the morning. The market's going to gear up to open up in about an hour and 45 minutes. And as you can see here, very random trading action overnight. But interestingly, the market still remains bullish, even after all of this upside that we've seen. I mean, look at this. Just going straight up without any type of reprieve. Now, notice that when we're looking at the market right now, we're right here back up to this level. And I mentioned the other day that there's a good chance we're going to stay around here for a while and decide whether the market's going to break down or not. Now, remember, I drew this line a long time ago. And you can see right here, that we're having a major issue getting past this level. Now, there's two ways this is going to go. We're either going to break out hard. I don't know about hard. Volume is starting to get really low, and volume is really low starting now for the last 2 weeks of the year. Next week, it's just going to be completely off. But you could see right here that we have major resistance. And the question is going to be, are we going to plow through this area right here and just come back up, or are we going to break through the 8-day EMA? And that's a very important question. Now, notice right here, this is the 8-day EMA. And notice here, we're kind of stuck right at the 8-day EMA, and now we're coming out. Well, what should happen, theoretically, is market should consolidate again and get close to this. The 8-day EMA should catch up, if you will, to price action, which it will if price action stays here and doesn't run away. But this is a little too much too fast for even the S&P 500. You'll notice here it happened and it consolidates, here it happens and here it consolidates, and it happened here again. Not only do we need to consolidate, but we need to take into account the fact that this is year end, and that's really important. But right here is the all-time high. We're only 7 points away on the S&P 500, which is not all that significant. And if you look at the QQQ, which is pretty important here, we're driving up there. And if you look at the all-time highs, we're there. Look at that. We're literally there. So there's a good chance we will see that on the SPY too. Now, on the Dow Jones, one second here. On the Dow Jones, we're actually above that level, and we're on our way to making all-time highs. So the only question is the S&P going to catch up, or is the S&P going to consolidate and back off on this level? Here you could see the weekly, and you could see how hard it's hitting that resistance level. And it'll be interesting if it happens, but boy, oh boy, the market has been bullish, been really bullish. Now, as far as Fed data, you've got housing starts and permits today. Very important report for the real estate market and very interest rate dependent. Tomorrow, you've got existing home sales and consumer confidence. Then you get into the big ones, GDP and personal income. This is a report that the Fed is going to be looking at, and so will be the GDP. Big reports. Jobless claims, nothing burger. Manufacturing could be important. Consumer sentiment, I doubt it's going to be very important after what we've been seeing. But these reports, this existing home sales and housing starts, they're very important. What we've been seeing lately is housing starts have been picking up, but existing home sales have been kind of waning. That's pretty cyclical, and that's also a factor of seasonality. So I wouldn't take that to heart too much. Now, let's talk a little bit about global economy, and then we'll back into bonds and sectors. Optimism about interest rate cuts from the Federal Reserve next year continues to underpin sentiment, with investors bracing for the release of fresh data on housing starts marking, which is exactly what I was talking about. Benchmark S&P is now at a 23-month high. Nasdaq 100 is at a 2-year high. I mean, they just can't stop. Now, here's where it gets interesting. Goolsbee stated on Monday, he's now saying, guys, he's now trying to tell people, you're misinterpreting what we're saying. Look at this. That the markets might have misunderstood the central bank's intended message last week and countered the notion that the Fed is actively preparing for a series of rate cuts. I was confused. Was the market just imputing, here's what we want them to be saying? He's saying we're not ready there. We're not there yet. Mester said that financial markets have gotten a little bit ahead of central banks' anticipated early interest rate cuts next year. The next phase is not when to reduce rates, even though that's when the markets are at. Folks, I can't get any more clear than that. The Fed's now telling you the same thing that I've been telling you for the past few days. But here's putting more doubts. This is where you guys get the hope from. San Francisco, no doubt, California. Mary Daly said the reduction to the U.S. Central Bank's benchmark rates are likely to be appropriate next year due to an improvement in inflation this year. But notice she didn't say anything about March. This guy's saying we're getting ahead of ourselves. This lady's saying we're getting ahead of ourselves. She's saying next year, but she's not saying when. Folks, March, here we are, 67% probability of a 0.25 basis point cut at the conclusion of the March meeting. You've got earnings on FedEx today, FCell, transports, FedEx, very important. Building permits, 1.47 compared to 1.498. That's the expected data. Housing starts will be reported. They're looking at 1.36 versus 1.372. It'll be interesting to see what they say. You've got Bostic speaking today, and I think he's going to just repeat exactly what everybody else has been saying. We're not there yet at reducing rates. Europe is up a little bit, giving us a little bit of tailwind. They're really focused on what's happening here in the U.S., obviously, and waiting for the core personal consumption expenditures. That comes out right here on Friday. That's a big report. China closed above its flat line, not really doing anything for us, muted between economic activity and summary. Semiconductor stocks advanced on Tuesday, while healthcare and real estate stocks underperformed. Japan closed sharply higher, hitting a 2-week high after the Bank of Japan kept its policy rates unchanged and offered no hint of an imminent end to the world's largest, literally largest, last negative regime. They've got to change that. They really got to change that. Typically this last couple of weeks of the year, markets trade on technicals. There's just not a lot of fundamentals. Folks are starting to cool off. If you look at the bond market, it's doing exactly the same thing as the U.S. stock market. Why? Because right now, the entire sensitivity of the stock market is in the interest rates' hands. That's the catalyst right now. And if this continues breaking up, that means there's a higher chance that interest rates are going lower, which you guys know how I feel about it. I think it's a bunch of nonsense, but here we are. If this backs down and starts coming down to the 200-day moving average, there's going to be a good sign that folks have been overestimating how good the economy is. Looking at each individual sector, which I really want to look at right now, I want to see what's been moving. So last 6 weeks, home builders, semiconductors, retail, Russell, everything focused towards interest rates. Look, real estate, consumer discretionary, real interest rates. Last 3 weeks, same thing. Mid caps, very speculative sectors. But look, communication services is down here, technology is down here. So in the last 3 weeks, it's been cooling off. But let's see the last 5 days. Home builders, Russell, real estate, retail, consumer discretionary, mid cap, QQQ. Communications even up here. Technology's down here, but everything else is up here. Granted, there's a huge congestion right now with these. Also, there's a lot of randomness in there. But just to show you, communications up here, technology's down here, consumer discretionary's up here. Things are all over the place, but we can't deny the fact that semiconductors, Russell 2000, home builders, real estate, retail, that's interest rate sensitivity. That's consumer demand, folks. And there's nothing we can do about it. That's what's driving the show. Now, we could agree with it or we could disagree, but that's where the market's at right now. Now, let me show you some interesting stocks that I'm looking at right now. If you go to 50-day lows, and it's interesting to look at stocks that are making lows because as soon as this market dumps, these are going to be the stocks you want to look at. So take a look at Lantheus Holdings, LNTH. It's breaking down nicely below support. And GPCR, Structural Therapeutics. Structural Therapeutics doesn't have a lot of structure, but look at these breakdowns. So you may want to start looking at these stocks. You also may want to start looking at 20-week lows, which same stock, LNTH. Now, what about 90-day breakdowns? Let's look at that real quick. Look at this. EXC, that same LNTH. A lot of indexes, not really relevant. Commodity index, not doing great with the stock market doing well. Look at Humana, healthcare stocks. Uh, Indexes, bonds, ETFs, bonds, ETFs, not really great stocks. Look at this, BYDDY. Oof, not a stock you want to buy right now. Not a stock you want to buy right now. The bottom line is, folks, markets are consolidating. They're looking for the next leg up. Not sure we're going to get it. And if the bond market craps out, if it doesn't take out this high and craps out, there's a good chance we're going to get a downtick in the U.S. stock market. Very, very important. Now, before I move on, please subscribe to my channel. Go to YouTube. Go to roger-scott.com. Next, come to my VIP room today at noon. It'll be fun. The link is below this video. And you can also subscribe to my Telegram channel. The link is also below this video, or you can go to rogerscott.com/Telegram. Don't miss out. Now, before I let you go, folks, I've been leveraging my new Pro Trader dashboard. Last 2 days, we took 2 winners, I think, for all of my trading since the summer, and the results have been fantastic. This is a no run-of-the-mill indicator or scanner. Sure, it might seem like there's a lot to take in first glance, but trust me, it's incredibly straightforward and easy to use. First, I give the market 30 minutes to settle down after the opening bell. This allows the dashboard to gauge the stock's average true range. Then simply I run the scan of the strongest and weakest stocks for the day. Keep an eye on these green, red arrows. They're your go-to signal for when to jump in and out of trades. And here's the kicker. It even pinpoints first and second profit targets and gives you a stop loss. Say goodbye to the days of trading in the dark, FOMO, and all that stuff. I know you're eager to dive in, so click the link below. Discover it now. Don't miss out. This is the best thing that's ever happened. I'm not kidding. I love this Pro Trader dashboard. See you guys later. Have a great day. Don't forget to send me an email. Let me know how you're doing. Let me know if I've been helping you at year end. Let me know if this year I helped you change your trading performance. Roger at rogerscott.com. Bye, guys. Have a great day.